So I have a question for you. Are you winning consistently or are you being profitable? Because the two are not the same. It's perfectly possible to be able to win very frequently but not make money, because it could be possible that you're being fooled by randomness. If you're interested in learning to trade on Betfair, then visit the BetAngel Academy, where you have detailed, structured Betfair trading courses. Or why not visit our website, where you can download a free trial of BetAngel Professional, but also visit the forum, where you can get detailed images, examples, and downloadable files. And don't forget to subscribe to our YouTube channel and click on the bell icon if you want notification of new videos as they're released. So yeah, it sounds a strange proposition that you win very frequently, but you don't actually make any money. And that is because trading is not actually a case of winning necessarily. I know that sounds odd, but I'll be able to explain a little bit further and give you some examples later on in this particular video. But when you're Betfair trading, and especially if you're a newbie to Betfair trading, everybody turns up and does exactly the same thing in my experience. And even if I tell you not to do this, you will do exactly the same thing. After all, winning feels good. It's nice. It shows you some evidence that you're actually doing the right thing. But, you know, what else are you supposed to do? You're supposed to turn up and start losing money? Well, no, of course you're not. But everybody will point you in the direction of a winning strategy. And everybody's focus sort of sits on that, because that's confirmation that you're necessarily sort of on the right path or doing roughly the right thing. But that's not really where your focus should be when you first turn up. And I know that sounds strange, but let me explain. But every newbie trader that I see falls into this trap. They just assume that what they need in order to be able to trade on Betfair effectively is a winning strategy. And that sounds perfectly logical. But if you're an experienced trader, you'll know that that isn't necessarily the answer. The funny thing about trading, if you do it properly, is that actually you don't have to win regularly to be profitable. You don't have to win frequently to be profitable. There's a whole mixture of different things that sit within that mix. And that is because, in essence, profitable trading is defined by three things. You need to know how often you win, your strike rate, how much you win when you do win, and how much you lose when you lose. And it's the combination of those three factors that will determine if you are profitable in the long run. Now, I have done a video on this. I'll see if I can dig out the final render of that and layer it on this particular section of this video. But I will put it in the end screen at the end, so you get a full detailed explanation of exactly what I'm talking about there. Because I don't want to repeat what I've said before within this video and just make the video an extra 10 minutes longer. But what I do want to do is try and get across the point of exactly what your objective is when you're trading and how it's possible to be fooled by randomness. Because most people assume that randomness is a flip of a coin. You get a coin, you flip it, sometimes it'll be heads, sometimes it'll be tails. But at the end of the day, you will find that it sort of balances out in general. And most people would ascribe the word random to a 50-50 chance. However, when you're in a trading market, random is nothing like that. And I know that sounds a little bit weird, because obviously if you go into the market randomly and you blunder away and just do stuff without any structure, you're effectively trading at random. But in essence, you're not, because everything has a different frame to it. So you may have seen me talk about this in prior videos, whether it be football, tennis, or actual racing itself. I've done specific videos talking to you about how you should be trading those particular sports. And the idea with the trade is you set up like a window of opportunity. You're sort of saying, this is what I'm going to do, this is my upside, this is my downside, and away you go from there. But of course, you will have a defined strike rate within that particular mix. And what do I mean by that? Well, when I first turned up on Betfair, the very first thing that I did was trade at random. Now, I don't mean just throwing money around randomly, doing things like backing this team, laying that tennis player, and I had to put some structure behind it. I basically said, I'm going to do this at this point to get into the market. If this happens at this point, I'm going to get out of the market. Let's see what happens. And that's a process that continues to this day. Using the automation on BetAngel, what I do is I point it at a market. I have this running 24/7. and it will basically do something in the market that I'm interested in. Now, for racing, you often see me posting up images, stats, data about stuff that's happening on individual sports. And that is because the data that I'm collecting basically spits out all of that information. What I'm really, really interested in is if I go into this market and I use no skill, in other words, what I would define trading at random, no skill, what actually happens. Because you will find that benchmark that you get from there is basically the way that the market is working. So if you go into a market, you do something and you get a 60% win rate, then in order to be profitable, you need to exceed that 60%. If you go into a market and the win rate is 20%, then you need to exceed that win rate to be able to make money in the long term. However, it's a bit more complicated than that because you've got your wins and your losses. But if you frame a market, for example, and you say, I'm going for a one-tick gain, how often does that happen? Then that effectively will give you, your one-tick gain is fixed, you have a certain strike rate that develops out of that particular strategy, and then you have a loss window as well, for want of a better word. And then your ability to trade that market profitably will be by tweaking those parameters. So you can't tweak your one-tick gain because you've limited it. You're just going for a one-tick gain. But you could tweak your strike rate or your exposure to losses. And that's the springboard that you need to be able to trade a market profitably. So where it fools people and where people get fooled by randomness is that the strike rate can pretty much be defined any way you want. If you said to me, hey Peter, give me a strategy in a certain market that gets me a 30% strike rate, I can say, okay, this is what you need to do. Hey Peter, give me a strike rate in this particular market that has a 99% strike rate. And I say, well, okay, this is what you would do. But the fact is that doesn't deliver profitability on its own, because that's an illusion. It's like I said, it's the combination of those three factors that will deliver profitability, and each market has a natural base rate. So when I use BetAngel to automate stuff and to be active and in a market, what I'm effectively doing is I'm searching for that base rate. I'm searching for the rate at which I need to exceed to become profitable. Now, if you look at a pre-off market and we sort of plotted all of the gains and losses in the market, you would sort of effectively get a bell curve of gains and losses. So the pre-off market has no underlying criteria to it. It doesn't sort of exhibit any bias within the market. It's just a distribution of gains and losses, and you sit within the middle of that, using your skill and judgment to be able to make money from that particular market. That's why I like the market, because there's nothing that you can't particularly encapsulate in that market. You're not handing yourself over to external forces. But when we do an in-play market, everything looks radically different. So, if we go into a pre-off market and trade at random, you'll probably break even over the long term, minus the commission. So you would lose money in the long term, but whatever strategy you deploy, as long as it's a mechanically deployed strategy, you will end up plus or minus nothing. Because say, for example, we were scalping, that's a high strike rate strategy. You will win very often scalping, but you're not particularly worried about the win rate. Like I said before, you're going for a one-tick gain. You'll hit a certain strike rate and you're more worried about the losses. Because if you can go 20 races in a row getting a one-tick scalp and then you wipe it all out with a market that goes 20 against you, then you're not going to be profitable. However, the strike rate will be particularly high. But if we go to in-play, you're dealing with a whole different scenario altogether. Your base rate is going to be completely different. So if you look at, and we'll continue the theme on horse racing, if we look at a horse racing market in play, all of a sudden we're looking at a whole different scenario in terms of what we would expect to happen. So let's, for example, start right at the basics and we say we're going to go into horse racing market and we're going to lay the favourite which just happens to be priced at 5s. Immediately we know what our strike rate would be if it's just an outright bet, because if we lay a favourite at 5s, it's going to win 20% of the time and it will lose 80% of the time. So our strike rate is 80%. We're going to win very, very frequently. So if you want to impress your friends, just go in and lay any favourite at 5s and you're going to win 80% of the time. But can you see the flaw here? It doesn't necessarily mean that you make money, because what you're trying to do is you're trying to find a scenario where the favourite will lose more than 80% of the time. That's how you would make money on that strategy, on just a straight value bet. So what happens with trading? Well, let's turn that value bet into an actual trade. And what actually happens when you do this is you know that your strike rate will be 80%. So you're going to win 8 out of 10 times. You're going to win very frequently. Whatever trade you do, whether it's 1 tick or whether it's 50, you're going to get that trade 80% of the time. So can you see where your focus suddenly shifts to? All of a sudden, you're not worried about that 80% when the horse loses. You're more worried about what happens when that horse wins. So if the horse goes on to win 20% of the time, which we know it will do in the long term because the market is efficient, what we're sort of saying really is that an in-play trade is not about when the horse loses. An in-play trade is about when the horse wins and how that occurs and the path that the market follows to achieve that. So if we narrow it down, we know we've got a 100% chance 80% of the time of winning, if you understand where I'm coming from. So whatever trade we do on that side is guaranteed. We are going to make money on that particular occasion. But if we look at that 20%, what we're sort of saying is the horse is going to go on and win 20% of the time. So if we lay it at 5 at the start of the race, and then we put a closing trade at some point within the market, what is the chance of the market actually hitting that closing trade, even though the horse has gone on to win? So if you think about it logically, it's quite easy to start to break down the problem. We know if the horse loses 80% of the time, our trade is going to complete whatever offset we use within the market, whatever trade we put into the market. If we lay it at post time, 80% of the time, anything is going to get filled. But if we suddenly say that the horse is going to win, think about it logically. There will be occasions where the horse is completely out of the mix and then storms back in the last furlong to go on and win. So it could be that you could lay it at 5 and get it matched at 500 perhaps. But how many times is that going to happen? Do you see that happen in every race? No, you don't. So the closer and closer you get that offset bet within the market on a lay to back trade, then the more and more likely that becomes. And of course, if you go and offset it by 1 tick, then of course that's going to get matched very frequently. But the smaller the gap to the size that you want to get matched, the more likely it is that even if the horse goes on to win, that trade will be complete. So I've studied the markets over a large number of years. I should have put the spreadsheet up behind me on the screen here, and I failed to do so. But what I may do is try and put something up in the middle of this video. But having traded the market over a very large number of years, I know all of the stats broken down in infinite detail on individual markets and all variations thereof. So I can tell you straight off the top of my head that if we go into a market, we lay the favourite at 5s, we offset it by 5 ticks. I'm not sure how 5 came up both times there, but that's convenient, isn't it? So we're going into the market, we lay it at 5s, we offset it by 5 ticks with greening. How often do you think that position will fill, even if the favourite goes on to win? Because we're not worried about if it loses, because that's definitely going to fill anyway. That's 100% strike rate. We're more worried about when the favourite goes on to win, how often will the price drift out, touch our offset at 5 ticks, and then the horse goes on to win the race. Have a guess before I do the big reveal. So it could be a 5 furlong race. The horse comes out of the stalls, absolutely skyrockets to the finish, and is never seen. It front runs and everybody's left for dust because it got off to a good start. Or it could be that the horse is held up, runs into a bit of traffic, but manages to find its way through. We're encapsulating all those variations within this particular calculation. So having monitored and traded hundreds of thousands of markets, I can tell you that if you go into a market, you lay the favourite at odds of 5 and you offset it by 5 ticks, you will get matched 70% of the time, even if the horse goes on to win. So the interesting thing about this is if we say 80% of the time we're guaranteed to win and 20% of the time we're going to win 70% of the time, if you understand where I'm coming from, because we're saying if the horse loses, we definitely win. If the horse wins 70% of the time, we will also win, but 30% of the time we will not. You can combine those two together. I'm not going to do the maths for you, but you end up with a strike rate of about 95%. There's near certainty that you will be able to make that trade work. But herein lies the problem. That is your market base rate. That is what happens consistently over time. That is not the rate at which you need to be able to make money. You need to exceed that somehow, either increasing the level of profit, which you can't because we fixed it at 5 ticks, or you need to somehow reduce your loss, or you somehow need to increase the strike rate in order to be profitable over the long term. So what I did yesterday, just to reiterate this point, is ahead of the big race, which I wanted to spend a bit of time on, I went into the market during the in-play period, and I actually did it on just the favourite. I didn't have any qualifying criteria, and I didn't choose a particular price for the favourite. But I basically went into the market at post time, or when the race was about to start, just put a trade in, offset it by 5 ticks, and then let it happen, let it roll and see what happened within the market itself. But what you can see is on doing those trades, I was using £50 stakes, you can see it won on a whole series of races. But the fact is I was using the base rate. I wasn't doing anything to attempt to improve that particular base rate. But you can see that I won very, very frequently. And, you know, that looks impressive, but the problem is we're not worried about the winning bit because we know we're going to win 95% of the time, near certainty. So what we're worried about are the losses, and when the losses occur, they will be significant, because imagine you're going into a market and you're laying the favourite with £100 at odds of 5. Your liability would be £400 when that failed trade comes in. So it's pretty risky. You're going to go through a very long sequence of winners, and then boom, you're going to get an absolutely massive loss that will wipe out everything that has gone before it. But that's what we're talking about when we talk about the base rate. What we're talking about here is a strategy that has a 95% success rate, but it still won't make any money, because when you focus on those 3 things, your win rate is very high, but relatively fixed. When you win, you're winning relatively small amounts, but when you lose, the losses are massive and they wipe out all of your potential profits. So yeah, when you look at a market, it's important to establish what the base rate is. Even if you're winning very frequently, it doesn't mean that you're being profitable, because it's a combination of all of those factors that go into one to be able to create your profit over a very long period of time. And the best measure of whether you're profitable or not is if you can sustain it for a long period of time. So when I go into a market, there are several things that I do. I run automation to tell me what the base rate is for that particular strategy. And then I can work on how I create the profitability out of that. I don't assume just because I'm winning that it's a profitable strategy. I'm just assuming that it's got an extremely high strike rate. And once I find that strike rate, then I can start playing around with those other components to be able to turn a strategy profitable. But the problem you find is nearly everything that gets pushed upon you as a new trader generally is a high strike rate strategy. And that is because it feels nice to win. And you can always write off those losses to just being unlucky, in inverted commas. But the fact is, it's just a fundamental part of trading. Flip it on the other side, you know, there are loads of strategies that I've got, and in fact, I prefer them because I tend to find they tend to be more profitable, that have low strike rates, where you lose frequently, but then you get the occasional big win. And those tend to be the ones that I've found to be more profitable in the long term. Everybody tries to hunt down those high profitability strategies, but there are so many people doing that it actually pushes it the other way around. And people tend to commit and go for those strategies so much that it tends to push it into a value territory from a trading perspective. So yeah, you know, I'd caution against that. I'm not saying that you can't do it, but necessarily, you know, it's a mistake to just pursue those types of strategies. It's perfectly possible to pursue strategies that have a low strike rate, that lose money frequently, but have a huge payoff when that payoff comes in. It's effectively the flip side of what we've just talked about. So yeah, you know, try not to fall into that trap. It's very tempting, and you'll find that everybody merchandises processes that give you a win because that feels good, and it makes you feel like you are trading profitably. But at the end of the day, you could just be being fooled by randomness.